Hello everyone and welcome back. In this video, we will discuss ISA 450 evaluation of misstatements identified during the audit. To begin with, during an audit, the auditor performs various procedures to obtain audit evidence. As a result of these procedures, the auditor may identify misstatements in the financial statements. Now, the important question is, what should the auditor do with these misstatements? This is exactly what ISA 450 addresses. First of all, the objective of ISA 450 is to ensure that the auditor properly evaluates the effect of identified misstatements on the audit and the effect of uncorrected misstatements on the financial statements. In other words, the auditor must determine whether the financial statements are free from material misstatement overall. Before moving forward, it is important to understand what is a misstatement. A misstatement is a difference between the reported amount, classification or disclosure in the financial statements and what is required under the applicable financial reporting framework. Misstatements can arise due to errors, fraud, incorrect estimates, omission of disclosures. Generally, misstatements fall into three categories. First, factual misstatements. These are clear and undisputed errors. For example, a mathematical mistake in calculations. Second, judgmental misstatements. These arise from differences in accounting estimates or judgments. For instance, disagreement over the useful life of an asset. Third, projected misstatements. These are based on audit sampling. In other words, the auditor projects errors found in his sample to the entire population. ISA 450 requires the auditor to accumulate all misstatements identified during the audit. However, there is an exception. Misstatements that are clearly trivial do not need to be accumulated. It is worth noting that clearly trivial is not the same as immaterial. Rather, it refers to amounts that are so small that they would not affect decisions under any circumstances. Furthermore, the auditor must communicate all identified misstatements to management on a timely basis. The purpose of this communication is to allow management to investigate the misstatements and correct them if necessary. If management corrects all misstatements, then the issue is resolved. However, if management refuses to correct them, the auditor must take further action. Now comes a very important step. If some misstatements remain uncorrected, the auditor must evaluate whether they are material individually or in aggregate. In doing so, the auditor considers the quantitative aspect like the size of misstatements and the qualitative aspects like the nature of misstatements. For example, even a small misstatement may be material if it affects compliance with regulations, changes a profit into a loss, or impacts key performance indicators. Therefore, materiality is not just about numbers. In addition, during the audit, the auditor may revise materiality. Consequently, the evaluation of misstatements must also be updated based on the revised materiality level. Moreover, the auditor must obtain a written representation from management stating that the effects of uncorrected misstatements are immaterial both individually and in aggregate. This representation provides additional audit evidence. In addition to management, the auditor must also communicate uncorrected misstatements to those charged with governance. This ensures transparency and allows them to understand the impact of misstatements and challenge management if necessary. Finally, the auditor must conclude whether the financial statements are free from material misstatement. If uncorrected misstatements are material, then the auditor must modify the opinion under ISA 705. On the other hand, if misstatements are immaterial, the auditor may issue an unmodified opinion. To summarize, ISA 450 deals with how auditors handle misstatements identified during the audit. First, the auditor identifies and accumulates misstatements. Next, these misstatements are communicated to management. Then, the auditor evaluates uncorrected misstatements for materiality. Finally, the auditor determines whether the financial statements are fairly presented. In conclusion, ISA 450 ensures that auditors make a well-informed and justified final audit opinion. That's all for today. Allah Hafiz.